Let us stress precise operational lifecycle of standard letter. Once the issuing bank approves the credit facilities, it transmits the LSEC securely via the SWIFT network, specifically using NMT 700 message forward to a correspondent bank located in the exported country, known as the advising bank. If the foreign exporter demands absolute payment security independent of the buyer bank or country risk, a third-party global bank may step in as a confirming bank. By adding its confirmation, the confirming bank accurately assumes the payment obligation, effectively absorbing the geopolitical and structural default risk of the issuing bank. The core principle that every corporation must master is the letter of credit deals strictly with a document, not with the physical goods themselves. Under ECP 600 rules, if the foreign exporter presents a set of documents that match the LC requirements down to the exact punctuation mark, the bank is legally obligated to honor payment even if the physical paperwork is delayed at sea. Conversely, if there is single documentary discrepancies, such as misplaced for a name or incorrect shipping weight of the invoice, the bank will freeze the payment until the discrepancy is formally waived by the payer. This rigid document-driven structure provides unparalleled legal continuity, ensuring the seller guaranteed payment upon proving shipment, while the buyer guaranteed that their capital is never disbursed until legal title ownership documents are verified by institutional experts. Section 3. Standby letter of credit and bank guarantees. While commercial letter of credit function as the primary vehicle for the executing day-to-day trade payments, corporate banking offers a distinct, powerful variation designated as a secondary financial safety net. The standby letter of credit of SBLC, alongside its international counterpart, the bank guarantee, the understanding the sharp operational boundaries between a primary commercial letter of credit and standby instrument is critical for corporate finance executive structuring complex global commercial agreements. Unlike traditional letter of credit, which is designed to be drawn down as the normal method of payments, a standby letter of credit acts as an emergency performance of payment guarantee. In essence, it is a contractual promise issued by a bank stating that if the corporate applicant fails in to compensate the beneficiary in a healthy commercial relationship, SBLC sits squarely in a background and is never drawn upon. It is only activated in the event of contractual breach of financial default. Consider real-world corporate application. A U.S. multinational enterprise is constructing a massive corporate logistics hub and hires a foreign engineering, procurement, and construction conglomerate to protect itself against the risk of the contractor abandoning the project halfway through construction. The U.S. enterprise will require the contractor banks to issue performance SBLC. If the contractor fails to meet specific engineering milestones of default on the timeline, the U.S. corporation can present a formal statement of default to the issuing bank and immediately withdraw the decided by financial compensation. Furthermore, corporate research frequently deploy financial SBLC to backstop long-term supply agreement or secure local trade credit lines for foreign subsidiaries. For instance, if a U.S. parent company has subsidiary operating with Western Europe that makes source for transfer local suppliers on open account terms. Local Europe suppliers may demand financial securities. Instead of moving physical US dollar liquidity across the Atlantic, the parent company as bank can use of financial SBLC to the European suppliers bank. This structure resulted in institutional grade financial backing, allowing the foreign subsidiary to secure flexible localized credit lines that based entirely on the financial strength of the US parent company balance sheet. Section 4. The rest of supply chain financing and inverse factoring. As a technology transfer modern transaction banking, forward-thinking enterprises are moving from rigid legacy trade instrument toward highly optimized working capital standard models, specifically supply chain financing, also known as SCF or inverse factoring. This structure financial solutions represents a massive shift in how global corporate banking groups help buyers and suppliers to optimize their cash conversion cycles consequently. In a traditional trade dynamic, the buyer's goals to extend payment terms directly harms the supplier's cash flow. If a massive US retail corporation demands net 90 payment terms from its small to medium sized manufacturing suppliers, those suppliers must carry the operational cost of production for 3 full months before receiving capital. This places severe financial strain on the supply chain, increasing the risk of suppliers' bankruptcy, production delays, and compromised quality. Supply chain financing resolves this systemic friction by leveraging the superior corporate credit ratings of the large buyers. Here is the exact operational framework of an institutional SCF program. The process is managed through the secure digital platform provided by the corporate banking partner. When a supplier ships off goods and subplots their commercial invoice, the corporate buyers reviews and formally approves the invoice within the platform, acknowledging an unconditional obligations to the payment full amount at maturity, say in 90 days. Once the invoice is approved, the bank offers the suppliers a choice. They can either wait the full 90 days to receive the 100% payment, or they can click a button to immediately liquidate the invoice at a slight discount. The breakthrough innovation of SCF lies in the pricing of that discount. Instead of the discount rate being based on the small supplier's high credit risk and expensive local borrowing costs, it is calculated based on the large corporate buyer institutional grade credit profile. The supplier receives immediate low-cost liquidity within 24 hours of invoice approval, allowing them to reinvest in raw materials and maintain continuous production. Meanwhile, the corporate buyer successfully preserves their 90 payment terms, maintaining deep operational liquidity on their own balance sheet. This creates a powerful financial synergy where a strength of the corporate balance sheet actively fortifies the operational stability of its entire upstream supply chain network. regulatory compliance, anti-money laundering, and OFAC screening. As through this global trade finance masterclass to a conclusion, we must turn our attention to the absolute paramount pillar of international banking operation, the regulatory compliance and transaction securities. Because trade finance instruments handle trillions of dollars in cross-border capital, they represent the frontline defense against international financial crimes, money laundering networks, and state-sponsored sanction evasion. For corporate treasury pins, absolute alignment with bank compliance protocol is non-negotiable. Every international trade transaction passing through the U.S. banking system or ETB's corresponding banking networks is subject to automated real-time algorithmic screening. Financial institutions enforce rigid know your customer or know your customer anti-money laundering or AML protocols mandates by federal frameworks like the USA Patriot Act and FinCEN directives. When a LC is issued or supplies, chain finance payment is executed. The bank's compliance architecture instantly screens every entity involved, including the buyer, the seller, the shipping line, the maritime vessels, the port of origin, and the ultimate beneficial owners. Against global sanctions database managed by the Office of Foreign Control of OFAC. If corporate treasury fails to conduct the proper upstream due diligence or accidentally structures a trade transaction involving a sanctioned shipping company, an unverified maritime vessel, or a blocked entity in a restricted jurisdiction, the consequences are immediate and catastrophic. The corresponding bank will instantly interdict and freeze the funds. The credit facilities will be locked and the corporation open itself up to civil and criminal federal penalties alongside devastating damage to its global banking reputation. Furthermore, banks actively monitor transactions for signs of trade-based money laundering or TBML. This includes the identifying anomalies such as over-invoicing, under-invoicing, phantom shipping, where documentation is fabricated, or structural discrepancies between the description of goods on the commercial invoice versus the actual customs manifest. By implementing enterprise compliance programs, maintaining flawless documentation transparency, and utilizing corporate banking platforms that features and build regulatory vetting costs, multinational corporations can ensure their cross-border trade corridors remain completely unobstructed. Flawless compliance execution ensures predictable transaction splits, preserves access to global capital corridors, and secures the enterprise position as a trust leader in global commercial arena. Thank you for attending Advanced Global Trade Finance Masterclass. We highly recommend reviewing your international procurement pipelines, evaluating the credit risk profiles of your key foreign suppliers, and collaborating with your transaction banking relationship teams to deploy the optimal trade instrument discussed today. See you next in the video. Video 3. Global Trade Finance Instruments and Supply Chain Risk Mitigation Solution. Section 1. The Anatomy of Cross-Border Trade Risk. Hello, welcome back to my YouTube channel. In an increasingly globalized economy, the physical movement of goods across borders is inextricably linked with the complex movement of capital. However, unlike domestic commercial transactions, where legal frameworks are uniform on counterparty, trust is easily variable. Cross-border trade introduces an intricate matrix of risk that can severely disrupt an enterprise balance sheet if left unmanaged. When a United States-based corporation enters into a high-value procurement contract with a foreign manufacturer, whether outsourcing advanced semiconductor components from Asia, heavy machinery from Europe, or raw materials from South America, both parties face a fundamental structural conflict of interest. The buyer naturally wishes to delay payment for as long as possible, ideally until the goods are received, inspected, and successfully sold into the local market. This preserves the buyer's operational working capital. Conversely, the foreign exporter wishes to secure payment as early as possible, ideally before production begins, to cover their raw materials costs and eliminate the risk of buyer default. This conflict creates the trade financial gap. Bridging this gap requires the intervention of global commercial program in banking institutional action acting as neutral, creditworthy intermediaries. Beyond simple payment execution, international trade demands a robust understanding of geopolitical realities, maritime logistic risk, foreign exchange control, and jurisdiction-specific legal frameworks. A failure to secure this transaction properly can lead to severe financial consequences, including non-delivery of critical cargo, structural default by foreign suppliers, or the freezing of corporate funds in transit due to regulatory compliance oversight. The comprehensive for the comprehensive analysis, we will deconstruct the operational architecture of global trade finance. We will evaluate the precise mechanics of traditional risk mitigation instruments, such as commercial standby letters of credit. We will explore modern supply chain financing frameworks that optimize account payable cycles, and we will analyze the strict regulatory compliance protocols, including anti-money laundering and global sanction screening, that govern every international transaction. For corporate leaders managing cross-border entities, mastering this banking mechanism is essential to fortifying supply chains and maximizing working capital efficiency. The lifecycle and Section 2. The life cycle and mechanics of commercial letter of credit. To effectively eliminate counterparty default risk, global corporate banking relies heavily on the primary instrument of finance, international commerce, the commercial letters of credit, commonly referred to as a letter of credit. A letter of credit is legally binding documentary. The commitment is used by a buyer financial institution contractually guaranteeing that about absolute payment will be made to the foreign seller, provide the seller presents exact matching, shipping, and legal document specified within the credit agreement. Let us trace the precise operational lifecycle of a standard letter of credit transaction, which operates strictly under the international legal framework known as UCP 600, the Uniform Custom and Practice for Documentary Credits. The process begins when the U.S. importer, acting as the applicant, requests their commercial banking, the issuing bank, to open a letter of credit in favor of the foreign exporter, designated as the beneficiary. The corporate treasury must Sebentar, aku udah bikin komen iya must work cooperate with the banks of trade of letter of reference. This typically include clean bills of lading, commercial invoice, packing list, certificate origin, and Spanish intermediary reports. Once the issuing bank approves the credit facilities, it transmits the letter credit securely via the SWIFT networks. Sebentar.